Okay, have you ever heard the term currency reset? I know, it sounds pretty intimidating, maybe something out of a movie. But according to the source material we're looking at today, it's a real historical pattern, and it could have massive implications for everything you own, your savings, your investments, all of it. So let's break down what this concept really is, and more importantly, what it could mean for your money. Our source doesn't pull any punches. It calls it a seismic event, something that basically turns the whole global system completely upside down. And you gotta admit, that's a powerful idea. It immediately makes you ask the question, if the system itself gets flipped on its head, what on earth happens to all the wealth that's stored inside it? So, to figure that out, here's our game plan. First, we're gonna define what a currency reset even is. Then we'll look at what happens to traditional assets, the stuff most people own. After that, we'll explore three potential safe havens: gold, the digital wildcard Bitcoin, and even real estate. And we'll wrap it all up by looking at the fundamental choice this all presents for your wealth. All right, first up, a once-in-a-lifetime reset. The key idea here is that this isn't some random, out-of-the-blue event. The source frames it as the natural end of a very long, and maybe even predictable, cycle. So what is it exactly? Well, a currency reset is basically a major crisis period. It's when a financial system just buckles and collapses under its own weight. And the main culprits, according to the source, are two things: debt that has become totally unmanageable and really extreme levels of inequality. And believe me, this isn't some new modern problem. It's a pattern that has shown up again and again throughout history. And you can actually see that cycle right here. The source points to big historical examples, like when the Dutch Empire fell back in the 1600s, or more recently, that really chaotic period between the World Wars and the Great Depression. The argument is that these aren't just isolated events. They're the peaks of a recurring pattern that happens every 75 to 100 years or so, which, of course, really makes you wonder where we might be in that cycle today. So, okay, if these cycles are a real thing, what does that actually mean for the assets that we all own right now? Well, that brings us to our next section. We're going to look at what happens to so-called assets inside the system when that system itself starts to crack. To really get a feel for the stakes here, just look at this example from Germany in 1923. During their hyperinflation crisis, cash, actual paper money, became so worthless, so devalued, that it was literally cheaper for people to burn stacks of it for heat than it was to go out and buy firewood. Now that's an extreme case, for sure, but it is a powerful reminder of what can happen when people completely lose faith in a currency. So what are these inside assets we're talking about? Well, simply put, they're the financial tools that only exist within the system and completely rely on that system to have any value at all. We're talking about the cash in your bank account, your pension fund, your stock portfolio, basically any asset that's really just a promise or a line item on someone else's spreadsheet. Now, this is the really crucial point from the source material. It suggests that during a reset, these legacy assets could actually be targeted. The theory goes that the wealth held in savings accounts and big pension funds might be, tapered or quietly written down to help pay for new social policies, something like a universal basic income, which could be pitched as a way to make things more fair. This whole idea naturally leads us to the first big alternative that the source discusses: gold. It's presented as the classic, textbook example of an asset that exists outside of the traditional financial system. So why outside? Well, because the value of physical gold isn't dependent on a bank's promise, a government's decree, or even a digital network. It's a real, tangible thing that you can actually hold in your hand. It doesn't represent a promise from the system. It is the possession. And that makes it incredibly difficult for anyone else to mess with. Unlike national currencies, which can basically be printed into infinity, you can't just hit print on gold. The process of mining it is unbelievably difficult, it's super expensive, and it's incredibly slow. This natural, unchangeable scarcity is really the foundation of why it's held its value for so long. Now this is the part that really blows my mind. This slide right here visualizes that scarcity in a way that's hard to forget. If you could take every single ounce of gold that has ever been mined in all of human history, it would all fit into a single cube with sides just 23 meters long. That's it. That is the entire world's supply. It's just a stunningly small amount, which really hammers home the point about how rare it truly is. But, and this is a huge but, the source makes a critical distinction. Physical gold, coins and bars, is not the same thing as paper gold. Paper gold is just a contract. It's a digital record that says you own some gold somewhere. The big risk here is that these contracts can be created way more easily than physical gold can be mined, and that could potentially create a kind of inflated market that isn't actually backed by the real stuff.
Okay, but gold isn't the only outside asset on the table. Let's pivot and look at a much more modern alternative. Bitcoin, the digital wildcard, the new kid on the block.
The argument for holding Bitcoin in a reset scenario is, well, it's pretty compelling. Just like physical gold, you can control it yourself. But unlike gold, it's insanely easy to store and send anywhere in the world in an instant. And crucially, its decentralized design means it's built to be outside the control of any single government or bank. However, there is a major counter-argument that our source brings up. And for this, we need a quick history lesson. You ever hear of tulip mania? It was back in the 1600s, a classic speculative bubble where the price of tulip bulbs soared to absolutely absurd heights, all driven by hype before the whole thing came crashing down and wiped out fortunes. It's become the classic cautionary tale about financial bubbles. And that brings us right to the bear case for Bitcoin. For one, it's a very new asset. We just don't have centuries of data on how it behaves in a major crisis like we do for gold. The big concern is that its value might be driven more by hype than by actual utility, kind of like those tulip bulbs. And on top of all that, there's this huge looming question of government regulation, which adds a massive layer of uncertainty to its future. So we've talked about gold, we've talked about Bitcoin. What about something a bit more traditional, like real estate? Well, according to the source, property is a really unique case because it kind of has a foot in both worlds. It's both inside and outside the system at the same time. Here's the tricky part. On one hand, property is firmly inside the system. It's stuck in one place, you can't hide it, and that makes it really easy for governments to tax it. But on the other hand, it has this undeniable intrinsic value as shelter. It's a fundamental human need. The source suggests that rural, self-sufficient properties might be the most resilient, mainly because they're more insulated from the instability you might see in big cities.
So whether we're talking about gold, Bitcoin, or property, each one has a very different relationship with the financial system. And that brings us to our final and most crucial takeaway: your wealth, their rules.
This table really sums up the core trade-offs we've been talking about. You've got assets like cash and stocks, which are fully inside the system, making them vulnerable to being reshaped or even devalued. Then you have assets like physical gold and Bitcoin, which are outside the system, but they come with their own unique challenges, like security for gold and regulatory risk for Bitcoin. And finally, you have real estate, the hybrid, with its own risk profile of being both essential, but also impossible to move and easy to tax. So if you're going to take one thing away from all of this, let it be this. It all boils down to the difference between assets whose value is just a promise from the financial system and assets that have independent value all on their own. One is a claim on wealth, while the other is wealth. And that leaves us with the final question from our source material to really think about. If there were a truly seismic shift in the financial world, is the wealth you hold just a simple promise from a system that's under extreme pressure? Or is it a real physical or digital possession that you and only you truly control?